Once again, this is the final session of RSM's Tax Summit Week 2021, full speed ahead year-end tax planning. At this time, I'm pleased to turn our call over to our first presenter, Patty Berquist. Patty?
Thank you, Allison, and good afternoon, everyone. Congratulations on making it successfully to the last session of this week. You have navigated tax in motion all the way to the end. Now, we're ready to move full speed ahead to our year-end planning session, where we're going to present some highlights of what we've learned this week. So I hope that will be very helpful to all of you, and I'd like to introduce your panel today. Okay, first, we're your navigators. I am Patty Berquist, and I'm the principal of the Washington National Tax Office for RSM. And I'm joined today with Matt Talkoff. He is also a partner and the national industry leader for RSM. Now, Matt, would you like to say a few words to welcome our guests for this final session?
Sure, Patty. First, it's great to be with you, Patty, and it's great to be with all of you on the line. Patty, I guess I'd start by saying the same thing you started with, which is it's been an amazing week. First, I'd thank you, Patty. You're leading our Washington National Tax team, and certainly all the amazing presenters we had this week from Washington National Tax and a lot of the helpers throughout the firm, I thought did a great job. I certainly learned a ton. We were kicked off, Patty, this week with Dave Cotter and, of course, Jim Alex, and Dave being, in Treasury before as the lead role for tax policy, as well as the IRS acting commissioner. It was a great way to start it. And of course, we had Grace Perez Navarro speaking, and she's the Deputy Director of the Center for OECD's tax policy. So again, terrific speakers. And I guess, Patty, I'd end by saying the last class that I attended, I tried to attend almost all of them, was just a few minutes ago, Planning in Uncertain Times, and what a fitting title. I know our friends Karen and Andy and Krista and Ben spoke a lot about just planning in uncertain times, and I'm excited for what we'll be talking about, and hopefully get some questions from the audience as well about how do we plan as we go forward. So that's what I would say, Patty. Great week. Thanks again for everybody joining us, and excited for the next hour with you.
Thanks, Matt. Same here. I know that was a great session. I learned a lot, and it does leave you a little bit in an uncertain position just because we don't know what's really going to be happening on the Hill. But let's just cover a few of the key takeaways that we want to talk about this week, or this session. First, we're going to talk about our current environment. Then we're going to talk about some federal tax planning issues, some state and local tax issues. We're going to cover generally some international tax provisions and look at some credits and incentives that are available to all. Not to forget, though, we're also going to do a little recap on what to expect from the IRS. Now, we will cover tax planning for businesses and owners. We also are very thankful that we've had some great technology sessions this week. We won't be covering those today because I'm not equipped to do so, but there was really underscored the importance of tax technology and automation in our business operations and in our modeling. And then, Matt, you're going to close us out with some closing comments. So let's start with our learning objectives. After this course, you'll be able to discuss very intellectually as well the key considerations for businesses and personal year-end tax planning. And you'll also recognize that pending future legislation could present some challenges that you need to keep on top of. Now, I was planning on having a quote from Jay-Z, but I ran out of time. So we do have a quote showing my age from Arthur Godfrey saying that he is proud to be paying taxes in the U.S. The only thing is he could be just as proud if he was paying half the money. So with that, let's do a quick recap of the week. With tax rates predicted to rise, planning for the future is more important than ever. And this week, we learned about ways to plan for future tax increases. And we're going to call that planning in reverse, because it's a little bit different than what we normally think to defer income. We're talking about oftentimes accelerating income. But let's visit some strategies to help take advantage of today's lower tax rates before we uncover a few increases here and there. And Matt, I'd like to turn this over to you to sort of walk us through the current landscape so we can navigate our future here in these uncertain times.
Absolutely, Patty. And I think what we'll do is we'll start with our polling question as well. So we'll get a good sense from this group of how many sessions you've been able to attend. So Patty, why don't we start with you? So how many sessions, if each of you could please enter your response, and again, this is for CPE, so we need you to respond. Did you attend A, one class, B, 2 to 5 classes, C, 6 to 10 classes, or D, it says every single session, but we'll take 10 or more out of the 20, I think, Patty, right? So we'll
Absolutely. I think it's a great way to get your CPE all in one setting, and with the interesting topics that we've had and the great speakers, it was an easy deal.
Absolutely. So why don't we let folks get their answers in. We'll give it another 5 seconds. We're over 90%. So those last few of you, if you put it in, great. I'm going to move us forward right now. Okay. Well, good. It looks like many of you attended between 6 and 10 classes, certainly more than one, which was great. We're happy about that. And even some of you, your troopers, your true tax people, will give you that award. You attended every single session, so we appreciate that.
And for the person who is attending this session and only this session, we will make it worth your while. How about that?
Absolutely. That's right, Patty. So why don't we go ahead and we'll jump into some of the planning here now. So what you're looking at here on the slide, Patty and I thought it would be nice to put together a single slide to really highlight many of the topics that we spoke about this week. And really, this is also meant to just open our minds to what we'll be speaking about over the next 50 or so minutes. Obviously, individual income taxes. Many of you during these classes have told us that you are very concerned, interested, whatever word you'd like to use, about where are the individual income tax and the corporate rates going. What we want to point out, we certainly know, as we were told at the beginning session with Dave and Jim, that we've got this House language out there, and if you look at the House language, it clearly does not talk about specifically raising the individual income tax rate or even the corporate rate for most of us. But there's a couple of things there, right? 2 things. One is it's just the House language. The Senate still has a lot to say in this. We'll have to see where things go. And the second thing is, you've been hearing from all the different presenters, there is, even in the House language with the Build Back Better plan, there is this surcharge that's out there. So even though you may read headlines that say something like individual rates not changed, the reality is we need to look at where our income levels are. And for those of you that have, substantial income numbers, so if you are making $10 million or more, there's a surcharge on income under the House plan. And so that's a 5% increase. And if you're over 25 million, it actually goes up to 8% surcharge on that. And that includes all types of income. So capital gains, long and short term, interest, dividends, and ordinary income. In addition, we also know that if you're an active owner of a business, a flow-through business, and I think the last group with Andy, Krista, Ben, and Karen, they spoke about it. If you're an active business owner, you may also be hit for the first time with the net investment income tax if you have over, say, $400,000 or $500,000 of income. So again, these are proposals, but they're being talked about, so we need to be aware of them. So as we talk about planning, those are important things to remember. The pass-through deduction, Section 199A. Many of you pass-through owners or investors into pass-through businesses, you have been concerned that maybe that pass-through deduction would go away. Well, the House bill does not take it away. Again, we do see some surcharges, as we mentioned, but that isn't in that House measure that was just released. Long-term capital gains, I just mentioned. Although we don't see the rate increasing, it will increase if we follow the plan that the House has proposed, which is a surcharge on income over a certain amount. So important to make sure we understand that. Estate and gift. So many of you have been talking about estate and gift. We saw in the polls that we've been doing during these classes that you're very interested to know where are we going with respect to estate and gift planning. The grantor trust considerations that were discussed concern many of you. mark-to-market and lack of step-up upon death concern many of you as well. And certainly the possibility of bringing down the lifetime exemption from 12 million to say 6 million was top of mind. Again, the House measure that's out there now does not have any of those things changing. But again, Senate could change that, joint discussions could change that, but that's where we are today on that. Salt deduction, the salt deduction at a high level, it seems to be the hot potato, right? So conversation goes on, and the latest, as of just this week, right, we had changed twice this week as we were doing our presentations, but the House was proposing to raise the $10,000 cap that each of us on this line have been dealing with to potentially $72,500. And then, again, another proposal came out just last night to maybe going $80,000. So we'll have to watch where that goes. The Senate has already come out. Senator Sanders and Menendez have come out and said they think maybe it should only be available if we increase it to certain individuals that make less than, say, $400,000. So again, this uncertain times, we're not sure where things are going, but it's important to follow it and understand it. And then briefly on the right-hand side, unique items. Many of you have been asking questions about this thing called 1202, Qualified Small Business Stock. Patty and I will be speaking about it a couple of different times during this session. It's a substantial benefit for many investors that invest into these type of C corporation entities that qualify. There may be some limitations that are put on it. And that was also in the House bill. Carried interest. For those of you in the financial services world or any of you that have carried interests, it's been a discussion point for a while. There's a 3-year holding period for carried interest to become long-term. There was some conversation it might go to 5 years. There was some conversation it might change altogether. Right now in the House bill, it doesn't change. So we have to make sure that we follow what the Senate might do with this if it moves forward to the Senate. Like-kind exchanges, the real estate sector was concerned that the like-kind exchanges may go away. Well, the positive news in the House measure was that it was not touched. Again, we'll follow it, but right now that was good news with respect to like-kind exchanges. There's lots going on in the international world with respect to GILTI and BEAT and Pillar 1 and 2, and we'll cover a little bit of that. Certainly state and local conformity and workarounds was discussed in a couple of different sessions this week. I learned a lot. Pass-through entity workarounds was discussed. If you didn't watch those sessions, please feel free to go back and watch the replays. I'm going to skip tax controversy for a second because I'm going to come back to Patty in a moment on that, but technology was discussed in many of our sessions this week. Partner site, family site, corp site. There's lots of opportunity for all of us with our businesses or even our family offices to be able to automate better, to use data better, to plan better with respect to our tax policy changes. And technology is going to be key in driving that. So I hope you were all able to listen into those sessions. And if not, again, I learned a lot, and I definitely would encourage you to go back and listen to some of the discussions with respect to the latest on state-of-the-art technology that we're going to be using with our clients to help them do modeling and planning. And then finally, workforce impacts. We spoke a lot about just the fact that we have workers now in our businesses that are remote. We're figuring out, are we going to be in a hybrid environment? Are we going to go back to the offices? Are we going to be fully remote? What does that mean with respect to our nexus, compliance with state rules if we have employees that are sitting in various states or countries? Lots to consider there. And as I said, I want to go back to tax controversy because there's a lot, Patty, there's a lot going on in the world of the IRS, whether it's controversy or funding. And before we move to the next slide, I want to give you a chance to weigh in on any of these things, and certainly on the controversy side.
And thanks, Matt. And you are correct. I mean, it's not enough that we have all these complex potential changes that we have to watch for. But then we've got the IRS who's saying, hey, we've just got $80 billion. Let's start going, let's start enhancing our enforcement efforts as well as our customer service efforts and getting our technology where it needs to be. So stay tuned for that. There's going to be a lot of activity in that area, I predict. One thing I do want to say, and that is, where are we now? Just to let you all know that today, the BBB, or the bipartisan budget, the Build Back Better Act, is before the House to try to get things finalized, vote on it, and send it over to the Senate. What do you think is going to happen there? There's a lot of disputes between the Senate and the House on various provisions, and it will be up to the Senate to take a look and see what do we need to add. So some of these things that we might be breathing a sigh of relief on, that they weren't included in the House bill, they may find their way into the act itself, and we'll just have to stay tuned. It's probably going to be till sometime in November or even December, the end of November or even December, until we really know what's going on. So stay tuned and really make sure you're doing planning and modeling for various scenarios so you know how to act quickly. And that's all I had to say about that, Matt. So can you walk us through some planning considerations for businesses and owners?
Absolutely, Patty. And I know you're going to be back with more discussion on the IRS as well later on in this session. And you reminded me of something as well. I mean, as you I know, we're on late text with several colleagues almost every night when things come up with respect to what's going on in the House and the Senate. And we're obviously bringing everybody, we pretty much have monthly webcasts now to folks. So those of you that haven't attended them, we encourage you to sign up because, as Patty just mentioned, there's a lot going on, and we want to bring that real time to you all through our tax policy efforts. And a lot of our stuff's on our website as well for you to read and also review those replays. So great reminder there, Patty. So let's get into planning considerations now. So why don't we start with businesses and business owners? And so Patty used the term earlier, reverse planning. We in the we're our tax geeks, right? We always like when something interesting comes up that's different. We talk about reverse planning when we think rates will go up. So it's the reverse of what we usually do. Usually we come and speak with our friends and our clients about how do you push out the taxable event to a future year and maybe pull in expenses. Well, this year it might be the opposite. If rates do go up, and again, we don't know where things will go, but if you follow either rates going up or surcharges on certain folks or more net investment income tax for certain folks, then reverse planning makes sense. And so what that means is that we'd want to figure out a way to accelerate income into 2021 and potentially push out expenses into 2022 and beyond. And so from a modeling perspective, those are the things we need to consider. We could be doing things like terminating installment sales, or potentially with respect to expenses, trying to avoid what we call the all events test in our world of tax, where we try and make sure an expense doesn't hit currently and maybe pushes out to a subsequent year. And we would do that if it made sense in your specific profile where you think your personal rate might be going up. Just because the overall rates go up doesn't mean necessarily your personal rate would go up. It depends on how much income you have, what the character of income is, but it's important to be modeling this out and thinking about it. Another item would be elective capitalization. There are certain expenses like insurance where maybe we would normally take it on an annual basis. Maybe there are ways that we could somehow push them out to a future year when rates are higher. Additionally, from an accelerating of the income perspective, we'd want to review accounting methods. Most of you business owners or executives in businesses, you've got a ton of different accounting methods that you're considering every day, both on your financial accounting side, or the book side, the financial accounting side, as well as on the tax side. And there are certainly lots of different ways to impact the methods from an accounting perspective for tax purposes by going through and making certain elections or just making payments at a different time. So those accounting methods should be reviewed and considered relative to the model that we'd want to do from a cash flow perspective for taxes. The last two items here we wanted to point out, capitalized expense plans. Many of you that are in sectors that are highly capital intensive, take, for example, in consumer goods, if you are building retail properties, refreshing them, if you're in the restaurant space, building new restaurants or a new manufacturing plant in the manufacturing sector, life sciences, opening up new facilities to do all the great work that we're doing now with gene therapy and drug discovery and so forth. For all of you that have capital assets, it is the right time to be thinking about whether or not we want to expense them currently Or do we want to capitalize and push them out of ways? Because again, if our tax rate is going to increase, we may want that tax deduction in a subsequent year. And then last one we just put here, compensation and benefits is a topic that Patty's going to speak to in much more depth in a little bit. But just thinking about items like bonus payments at the end of the year. Those of you that are business owners or employees, when a bonus payment is made or how it's made or how it is agreed to, whether the all events test are met, could impact when it is considered either taxable income to an individual or when it's considered a deduction to the business. And so again, you have the ability to potentially move income and expenses around based on your plan with respect to bonuses and compensation at year end. So another item for us to be thinking about. Patty, before I move forward to the next slide, anything here in particular you want to call out as well?
Well, Matt, the one thing I do want to say as we talk about this bonus payments, we're calling this era the Great Resignation. And so this is really something that companies have to weigh as they consider, what do my employees need and what do I need? And so that really does require some modeling to figure out, am I better to make this includable in their income during 2021 for them, or make it a deduction for me in 2022?
Great call out, Patty. Absolutely. And as you say that, it makes me think too, again, when we mentioned it's all personal. All this stuff is so personal, right? So we can certainly give broad-based thoughts around, for example, reverse planning. Broadly, we say if rates are going up, you want to maybe consider pushing out expenses. But everything's personal. And, we also know taxes are one thing about taxes, they change a lot. And it's certainly a lever in Washington. So, for example, if you're going to sell your business, it may not be the right, you may not want to rush to sell it. Rates could change again 4 years from now or 8 years from now. So it really does depend on your personal situation, and which is why modeling is so important. I know, Patty, you and I have been on a lot of conversations where we're modeling out choice of entity, and we'll get more into that in a minute. But I know I've been surprised in certain situations where what I thought would be the case, really wasn't. I'm sure you have as well.
Agree.
Great. Okay. Now, why don't we, on the next slide here, so reverse planning, again, we call it reverse planning. So private clients. So for you, the individual business owner, the individual investor, just the high net worth individual that has a family office and so forth, here are some things that we would want to consider, right? So one is closing on M&A transactions. So, is it the right time to go ahead and recognize a gain on a transaction of an investment you own, whether it's a business or even a portfolio, a stock investment, right? If you are one of the individuals that might be in that higher net worth area that could be hit by either increased tax rates if they do go up, or even if you're hit by those surcharges that we talked about, which could be as much as 5 or 8%, and adding net investment income tax, it could be 11.8%. So big potential rate increases. So consider whether it's the right time for a transaction now. And we also noted from a structure perspective, we find a lot of our friends and clients that don't realize that they might be holding on to stock which qualifies for Section 1202, qualified small business stock. And there's a great exclusion benefit for that, which exists today. And even under the proposals, although it's being pared back a bit if it goes through with the House measure, it still can apply. It may not be as beneficial as it is today, but it still applies. It's important to ask the question, do I own Section 1202 qualified small business stock? So that's one thing for the individual investor and business owner to be thinking about. The second one kind of goes very close with that. Again, selling a business before year end. So do we want to structure our rollover as a possible taxable event? We work with a ton of private equity groups, and certainly our private equity clients or our business owner clients that are selling to private equity often structure a transaction where the business owner would stay on for a while. That business owner may want to continue their interest in the company that's being acquired. Historically, we'd say, well, defer that tax, just defer, roll it over, retain your interest, and don't pay tax. We need to be thinking about that because if rates are going to go up, might it make more sense to go ahead and trigger a tax event now? Again, very personal, but it's something to model out and think about if you are considering a transaction. Certainly accelerating gains in appreciated assets. I wish I owned more appreciated assets, but the few that I do have, I'm considering potentially selling some of them to see if I would lock in a gain now. I'm not in those surcharge rates, but I don't know what the Senate might do with respect to tax rates and if they go up or down. So I'd say that this to all my clients, consider whether we want to go ahead and sell appreciated assets now and restart. And if you like the asset, you could buy it right back and restart your basis at a higher point. Again, it's going to be personal, but something to at least consider. Leveraging recaps in 2021 might be an idea to do some recapitalization, trigger a dividend, potentially tax at a lower rate today. Again, if you think you're in the surcharge rates or in increased rates, you could pay 5 or 8% lower this year versus next year potentially. And then exit C Corp structures. This is going to be a hot topic, choice of entity. Should we go from flow through to C? Should we go from C to flow through? Do we want to trigger any accumulated earnings and profits that we might have in our C Corp that we own right now? These topics are something that business owners are going to be considering and should be modeling out because they do impact taxes directly, and they are a consideration when we see rates potentially changing. Patty, before I move forward on the private client to the next one, any comments you'd like to make here?
Well, again, Matt, I think it also depends on your individual situation. I hope if you sell your appreciated property, it does not destroy the markets for the rest of us, Matt. So I just give you that caution. Do us all a favor. But no, it really does depend on what you want to do. If you think, hey, I want to take advantage of 1202 and you're selling your family business that qualified for 1202 to get that benefit, how do you remain in control of the business, or how do you get to tap into the appreciation of that? So it's going to require modeling and planning for sure. What we're saying here today are just ideas for you to consider, and it's really up to doing that individual modeling.
Absolutely, Patty. Good advice. And I promise mine will now move the market. So now active and passive individual investors. So all of you that are out there that may be, again, business owners in a business that you are currently running, or a family member and you're also involved in the business, right now there's lots of things for us to be considering. So one of them would be utilizing the estate tax exemption. As we mentioned at the beginning, there's been a lot of discussion, and many of you have been asking these questions on our monthly WebExes, which is, hey, I thought we were going to be reducing the lifetime exemption from approximately $12 million down to $6 million or 5 or 3 or some lower number. And then you were asking the question, oh my gosh, they're now talking about changing the grantor trust provisions, and those are things that we've been using forever with respect to estate planning. And I'm hearing about mark-to-market and maybe losing the opportunity for step-up at death. And again, what we said at the beginning was that those provisions are not in what is in the House measure right now. The language for the House text that came out this week doesn't mean they couldn't come back. Nothing is dead until all of this is done. But right now, we don't see it in the House bill. So it might be a perfect time to go ahead and do your planning and move certain assets to next generation, to utilize trusts, to fully fund your irrevocable life insurance trusts. I know both our estate teams as well as the legal estate teams are very, very busy right now. So if you haven't had that discussion, please do have it with your advisors. We're having them all the time, and it's an important topic. The next one would be charitable planning. We are in a unique situation now where under the right situations, if you were so inclined, you could potentially eliminate 100% of your adjusted gross income through certain charitable donations this year. You could do that, or you could also say, you know what, I want to save some of my charity this year that I would normally do for next year because I think rates might go up. All that stuff needs to be considered. What's important under the House bill to know is that charitable donations are not a deduction against the surtax calculation. So that's an important thing to know. It's a little confusing. You do get to take charity and reduce your regular income and your regular tax, but if you are going to be subject to the House measure, if it passes, for a surtax, for those making more than $10 million, right now, at least the way it's written, The charitable donations as well as state and local taxes are two examples of deductions that would not bring you out of that surtax for individuals. There is an exception for trusts and maybe estates, but for individuals, that's not the case. Another thing to consider would be, where might itemized deductions be going? So we need to model that out from a charitable planning perspective. There were some discussions that there'd be limitations on the benefit of an itemized deduction, like charitable deduction. So we need to consider that. Certainly self-employment tax planning, it's always something to consider. And it goes into the flexibility of our structure. We need to look at, certainly in the fund world, there's a lot of discussion around, do I use a limited partnership? Do I use a limited liability company? Are the rules going to change? How do I consider having a general partner interest or a limited partner interest? We need to be very careful in thinking about those structures and the planning there. Capital gain planning. Certainly if you're in a situation where you have some unrealized losses and you're thinking about potentially utilizing them, well, if we do see rates going up next year, we might want to not harvest those losses this year. We might say, let's pay our capital gain tax this year and save some of these losses to offset either higher surcharge taxes next year or higher individual rates next year. So something to consider. And again, that's that reverse planning to think about. We shouldn't go on autopilot and just always assume we want to capture losses at the end of the year to offset our gains. That may not be the case this year. And then finally, accelerating ordinary income. If we think rates are going to go up next year, might we want to convert our traditional IRA to a Roth IRA and pick up income and pay tax on it now, and then have it be tax exempt essentially in the future? And the last one here on the bottom is something important to think about. If we are an active investor in a business, if we will have the net investment income tax of 3.8% applying to us next year, might we want to figure out a way to accelerate income this year and avoid that additional tax next year? So something very important to think about as an active business owner in your business. Patty, any comments here?
Matt, that was a great summary, and I have nothing else to add to that. But maybe it's time to visit our next polling question.
Absolutely. All right. So full speed ahead, year-end tax planning. So our question here is, let's see, I'm having a little trouble seeing the top of it. So as you think about the planning opportunities you've heard about so far, do you plan on implementing any of them? So the items that Patty and I just went through, do you plan on implementing any of those items? A, yes, B, no, or C, you're not sure. So we'll give you a little time to step in. Patty, I'll ask you, anything there that you're going to try to implement or think about?
Well, I think you've given me a lot to think about on capital gain planning. I know someone in my family is planning on selling a large asset, and there's a lot involved in consideration of that. We need to make sure it closes during 2021. That's the first order of business for me.
Absolutely. Good point there, Patty. All righty. Why don't we, let's see, I'll give another 5 seconds. We've got 90% of the people already entered. Mm-hmm. So those of you, get your last answers in. We're about to move it forward. Okay, it looks like you got it in. We're going to move it forward. Great. That's terrific. I mean, also only 5 of you say no. So 95% of you are either yes or unsure. So hopefully we're giving you some good information to be thinking about. Certainly over half of you are going to be implementing planning. So that's really, Patty, I don't know, that's encouraging to me. Hopefully we've done a good job of informing. Yeah.
I think some of our topics have resonated this week, and people are going to take advantage of it. But I also appreciate those people who are still a little bit unsure. So that, just takes more time to investigate. Absolutely.
Why don't we jump in? I'll start us off, and I'm going to turn it over to you for a few slides, but I'll start with entity choice and structure. We've hit a little bit on this, Patty, as we've just talked, but why don't we just kind of mention a few things here. So from an entity choice perspective, and Patty, in our conversations with our functional leaders and our relationship leaders with clients, we've heard a lot of them tell us that their clients are asking a lot of questions around entity choice. Should I stay a flow-through entity? Should I be a C Corp? Should I convert C Corp to flow-through? If I've been taking a lot of money out of my fund, Should I leave it in and basically pay a 20% rate? I don't want to pay the surcharges. Questions like, how do I, if I leave money in my C Corp, how do I need to invest it so I don't get hit with a penalty for accumulated earnings? So all those things are coming up, and it's really complicated stuff. And Patty, I know you and your team have developed some models to help us think through structuring, I think, from a choice of entity perspective. Is that right?
And that is true. We have a comprehensive model that we have used with many clients, Matt, to really help them analyze. It's not just what's the current tax benefit, but it's really looking at long-term strategy and how that client wants to restructure their business or have a succession plan, how long they want to hold on to it. So really there are a lot of moving parts to that, and I think the model does a really good job of walking them through.
I absolutely agree with you. Yeah, and thank goodness for the models, because it's really complicated. Again, why we're developing all this technology in the tax world to be able to help individuals do a lot more planning.
Absolutely.
Yeah. So as you can see, the topics on the left, accelerating dividends and capital gains, we spoke a little bit about it already. Important to think about that and model it out depending on what your personal situation will be. Certainly corporate freeze transactions where you could potentially freeze the value of a certain asset and maybe do some estate planning around that with some preferred interests. It's a very powerful strategy from the standpoint of, estate planning as an example, and even just income tax planning. Leverage capitalizations. We can look at converting of C Corps and S Corps and back and forth. And you might have a business in an LLC that you say, I want to convert over to be eligible for Section 1202. So lots of different considerations there. With respect to the last item I mentioned, again, with rising rates potentially there, Section 1202, if it stays fully in force, is a major benefit for a lot of individual investors to be considering. Buyers may not like to buy a C Corp, so a lot of different considerations that we don't have time to go into every consideration with 1202, but it certainly should be something when you're structuring a business that should be on the list of items to be considering. And that's one of the things that we have been talking about a lot with clients certainly the last couple of years. And again, I've managed to meet a lot of you probably on the line, and as investors, you didn't even realize you were holding the stock that was benefiting that much, and it's a nice little surprise when you get it. Any final words on this, Patty, before we move over to the next slide?
I was going to say, Matt, you raised a really good point that it is also about the structure can bring with it certain additional responsibilities. If you're buying a C Corp, you're buying the black hole. You need to be protected from any unknown liabilities that could come up and be putting the assets at risk for taxes or other liabilities. So it really is important. There's no quick, easy solution, that's for sure.
Absolutely, you're right, Patty. All right, Patty, do you want to lead us through polling question 3?
Sure, I would. So now that we've heard some really interesting ideas here, do you expect that during the next 3 years, your workforce will be at least 50% remote? The answers are easy. Yes, no, or yeah, I'm not sure. Now, this is a really significant area. We mentioned earlier something called the Great Resignation, and you guys have probably been hearing a lot about this and seeing this term. And it really is important that you figure out what your business needs and how you can be flexible to retain your employees to the extent that it is possible to do so. So what we have, about 81% of you have been answering the question. So let's get those answers in. I would imagine many people are not really sure yet. I know our firm has found that flexibility is the key, and we have many plans in place to help various teams. It depends on what that team does as to whether or not they need to be in an office, or can they work 100% remote or use a hybrid model. So I think we're ready to close this poll, Matt, and let's see what we got. Okay, so many of you are expecting that 50% of your workforce is going to be remote. And some people say, nope, that's not the way it works. And, you can see in the restaurant industry or a retail outlet, you can't really have remote workers very much. And then there are a lot of you who are saying, we're just not sure yet. We're evaluating. And so that too is really good. Well, with this theme, I would like to take the next slide here and talk a little bit about planning considerations in response to COVID and these tax rate changes potentially and other changes, and really look at comp and benefit planning. Now, the first thing, and what we found in this last year, was something that was really spectacular for many companies, and that was the employee retention credit. So the idea here is look into this year to determine eligibility, because this credit can be very lucrative. We had many clients who said, no, it's not going to do anything for me. And they were surprised when we ran some numbers, and they're like, well, okay, I'm all in now. So it's really important to look at that. Now, the other thing is to stay tuned, because the House bill was going to eliminate this credit for after Q3. However, we don't know what's really going to happen yet. We've gone sort of back and forth on this, so stay tuned for this to see if Q4 would be involved. But even if it's not, make sure you're taking advantage of that credit. Next is the changing workforce dynamic. Now, you think about this, hey, why don't I just go stay in my vacation home? I'm remote, my office is closed. What are the impacts of that on your employer? Because it could open up nexus to state taxation for your employer by having people in that jurisdiction. There is often more than just the people factor, but it's something that employers need to be looking at. So review your employee locations and your policies regarding expenses and benefits. What's changed, and how does this reporting for them need to change? Now, there are plenty of software programs out there that will do this, that will look to see where are my employees and what does this mean for me? So that's something to take advantage of. What about worker shortages? Well, look at your overall rewards package. We were talking just a few minutes ago about when is a bonus going to be accrued. And it may be really important to provide this benefit to your employees to put it in their comp for 2021. So that's where the employer's actions come into play. And then looking at overall compensation planning, reviewing incentive comp plans, equity plans, and deferred comp for impacts on pending legislation. And then understand the potential flexibility in plans and the impacts that could occur to that plan as a result of a rate change. So Matt, do you have any comments on that?
That was great, Patty. I mean, this is one of my favorite slides because it impacts so many of us, whether we're an employee or a business owner. The only comment I would add, because it's my favorite one, is the employee retention credit. I work with a lot of the consumer products type businesses, and certainly that was so impactful for restaurants and retail. And I would just encourage anybody out there that's listening in here, if you haven't at least looked at it to see whether or not the benefits there, we certainly have a whole team across the country that pretty much have been working full time on trying to capture these retention credits for our friends and our clients. So that would be the only one, Patty, I would highlight it a little bit more about.
And I agree with you. That has been a real benefit that a lot of companies didn't think they were going to get, and now they're happy they looked into it. So let's move on to some planning considerations for international, state, and local taxes. I'll start out with international. And the one thing I want to say, the theme here is modeling is everything, because there are some rapid changes that are potentially going to occur here. We think about accelerating income and delaying deductions. What does that do for us? Well, we currently have a lower GILTI rate. It's still a rate, 10.5%, but it could go up to 15% next year. The same with the BEAT tax, and we might have a little bit of a less of a benefit for FDII as well under the proposed legislation, if that goes through. The other important thing to think about is many of these proposals now have a country-by-country requirement, and that could significantly impact the taxation of your foreign entities. And the other thing to think about here is restructuring to minimize the impact of these rate increases. So that means, shouldn't I review my blocker structure to assess whether a flow-through is going to provide me better benefits, less taxes, and then recognize that income accrued from offshore funds may bring PFIC tax, and it's really important to consider whether or not you can benefit from a QEF election. What that does is it's retroactive, and it will allow for capital gains rates in prior years. So that may be really important as a planning technique to implement. And then model trade and indirect taxes. We did have a VAT session, and there was some trade discussions going on in that session. And so that's really important to consider the impact of indirect taxes. There could be transfer pricing elements that you want to consider, looking at the VAT tax and tariff modeling to determine how to minimize taxes on your supply chain. Now, we've seen a lot of supply chain impacts this year, and so this may be something that can help alleviate some of the burden. It's not going to get those chips in your hands any quicker, but it could help defray some costs. Now, the other thing to think about is consider GILTI and Subpart F income. There is currently a high tax exception if you're the foreign country in which you're operating in is a high tax jurisdiction. You can make an election, and that can assist in your GILTI calculation. Finally, I want to just mention, we had Grace Perez Navarro speak to us from the OECD, and she talked about Pillar 1 and Pillar 2 changes. Now, those are all effective in 2023. So it's important that you understand what's the impact of Pillar 1 going to be on my business, and what's the impact of Pillar 2, and whether or not changes to the GILTI rate now are really going to interact with Pillar 2 changes or be treated as consistent with Pillar 2 changes. So Matt, that's sort of a recap of the international tax planning. The next slide is really all about state and local tax, and I think that's yours.
Sure, absolutely. And I'll comment on the international tax. You said modeling is important. I 100% agree. In fact, I have 4 children. If I ever needed like 3 hours on a Sunday to sit on a couch alone, all I got to do is start saying to them, hey guys, you want to talk about, QEF, PFIC, GILTI, they just say, Dad, we're done. Bye.
Right.
So
we're out of here.
We're out of here. So modeling is critically important. And just thinking about withholding and treaties and structure, just so much stuff. So that's why so many people now are specializing in international tax. So great insights for us, Patty. On the state and local side, we had several classes this week on state and local taxation from, my friend Ryan Corcoran and several others spoke about pass-through entity tax. Today, I listened to Mobile Jacobs and a couple of other colleagues speak about just revenue for the state. So it's important to think about how states might react to everything that's going on in the current landscape. So our message here is, be informed. States are responding on a daily basis, whether it's changes to their income taxes, their sales and use taxes, how they view nexus, through your transactions as a business going into their states, making a marketplace for your products. All those things are kind of hitting us at the same time, and states are coming at it at different times themselves. So what we knew yesterday about one state might change tomorrow. So stay informed. Certainly the idea of the pass-through entity tax and workarounds is top of mind for many of us. Highly encourage you to go back and listen to that class. It was a very good class, so we won't go deep into that. Be flexible, be prepared to make changes, stay close to your advisors, talking about how this all impacts you, your footprint, where you operate, where you're living, your residency. I get 3 emails a day probably on questions from clients about residency. Should I go to Florida or New Hampshire, Nevada, somewhere else, Tennessee? So all those questions. Certainly look to maximize liquidity, take advantage of credits and incentives and opportunities to create better cash flows from a state perspective. Prepare for the impact of workforce changes like Patty and I spoke about. Our employees are moving all over the place. Whatever our model is with respect to hybrid or back in the office or remote, it has an impact from a state perspective to consider. And then again, take control of the situation. We have an amazing, great group of state and local tax professionals at RSM that spend all their time modeling out and thinking and considering how your business decisions are impacted by the way states are responding to certain situations. So let's stay on top of that. And conformity. I mean, Patty, we spoke about before. Federal government changes laws federally. Some states follow it, some states don't. Some states conform to some, but not all. All that's going to be really important for us. Any last comments on that, Patty, before I move it back to you for the controversy on the IRS side?
Well, I think it's really important to also realize that the IRS shares information with the states. So beware of that too. It goes a little beyond state and federal conformity there.
Absolutely.
But now, why don't we talk about a topic that is so incredibly interesting to everyone? And that is, of course, what's the IRS going to be doing? Now, we've all said they've got $80 billion potentially at their disposal. That has not changed in the last month, and it is in the current bill. And so they have said, we're going to double our workforce. We're going to double our examining teams. We're going to double our collection teams. And we can only hope they double or triple their customer service teams, because that is really lacking. But we've just thrown up a couple of ideas here to think about. Are you on the IRS's radar? Well, are you a global high wealth, somebody with significant wealth, or even in this tax year, do you have $200,000 of taxable income? That puts you on their radar screen. Are you a large corporation or a large partnership? There are programs designed for those entities. And then last, I want to say there are some Tax Cuts and Jobs Act compliance areas and CARES Act compliance areas. They're on the screen here. But be aware, the IRS has some consistent campaigns. They are really starting to attack and to start examining very fully a lot of these issues. So Matt, in the interest of time, I'm going to turn this right over to you since we have a little wrap up and a polling question.
Yeah, no problem. I also comment. I'm going to put a plug in for you. I'll make you blush, Patty. You were at the IRS Chief Counsel's office, and so what you bring to our webcasts and the insights you have and your team has with respect to where the IRS is going, that experience is so meaningful to all of us. So I know, you're a fan favorite when we do the webcast. So thank you for all you do to keep us updated.
And thanks for that plug, Matt. And by the way, let me just plug that session that Alina and I did, because it was very interactive and it had a lot more tips and tricks for handling an IRS exam. So it's well worth a rewatch on demand.
100% agree. I agreed with it. It was very, very, very good. So, well, as Patty said, we're coming to the end of our session. So just briefly, we're going to go to 2 more polling questions, but briefly, just a summary of planning ideas. We spoke today about entity structure and estate and gift and planning in reverse, what that means. Is it right for you? Is it not right for you, depending on your situation? Certainly transactions have a meaningful impact on taxable income. State and local, international, and certainly credits and incentives, a very important element in your tax and cash flow planning, whether it's the employee retention credit or work opportunity tax credits or energy efficient vehicle credits or energy efficient home credits. Lots of different things out there to be able to do good things and to minimize your tax cash outflow. So that's a summary of the ideas. I'm going to move forward to the polling questions to get them in, and then maybe Patty, you and I can just talk a little bit as we end this. But why don't we go to this polling question number 4? Did the tax summit meet your expectations? A, absolutely, and you cannot wait for next year, which I hope is the answer. B, yes, but you have some suggestions, which we're totally fine with that as well. Suggestions are always helpful. And C, not really. I'm hoping that we don't have many C's. Patty, you and I would be sad, but this is the question for your CPE, so please do answer it for us.
And it looks like we have about half of the people who've answered so far, so we want to make sure everybody's at least had 3 questions answered. And so try to get your answers in quickly.
Absolutely, yeah. Yep, that helps push it. So we're starting to get some more in there. So,
right.
So Patty, yeah, I mean, I it's interesting. This is the second year that we've done it in this format, at least the second year. And I attended, I think, 90% of the classes. I plan to go back for the 10% I missed. But I thought it was terrific. I learned a lot, and what I learned was that things change quick. How about you? Any insights from this week?
And I have to say the same thing. I think the topics that were covered were excellent, and I too want to go back and revisit some of the sessions and really take better notes than I did the first time around. So I totally agree.
Awesome. Well, we'll give it another 5 seconds. We're going to close this one out. Hopefully you've all been able to see it and respond. So I will move that forward in 3, 2, and 1. Okay, we're not going to show anybody those results because we don't show those things, but we basically appreciate you getting that information to us. Hopefully you were all able to answer your questions. Again, thank you for the whole week, for being with us. Many of you said you were here for 2 to 10 classes, which is great. Patty and I keep plugging the rewinds of it. There'll be emails in your email box that you can click to look for links to go for the replays. Please reach out to the folks that you're friends with at RSM for questions, modeling. If you need modeling, which again we highly encourage, join us. Jim, Alex, Fred Gordon, Patty, myself, Dan Ginsberg, our policy affairs leader. We're doing webcasts, and others, Ryan Corcoran and others. We do webcasts to keep you updated on tax policy. We hope you can join us for that. Subscribe to our alerts, and you'll get that information as well. So I just want to thank you, and Patty, I want to thank you for what you and your team have done. So I'll turn it over to you for the final words, Patty.
Okay, well, thank you so much, Matt. And we had a lot of great speakers, both within W&T and in our practice offices. So it was really great to get to hear them. Now, we'd like to invite you all to join us, meet us in the networking lounge so we can answer any other questions that you might have. I'm going to give Matt all the hard questions. But anyway, we really appreciate you joining us, and we hope you enjoyed your experience, and you'll come back next year.
Great. Have a great weekend, everyone.
Thank you all.
Patty and Matt, thank you so much. Thank you to our audience for joining us, and thank you to all of the presenters that participated in RSM Tax Summit Week. If you have met CPE criteria for this session, you can download a copy of your certificate by visiting the Certification Center and clicking the download icon. This is the case for any session that you may have attended this week. Simply use that webcast link to re-enter the webcast, launch the presentation, and download from the certification widget. As Matt and Patty were mentioning, we will have the recordings from all of the sessions available next week, so look for a wrap-up email with that and the links to view all of those sessions again. Patty and Matt, my favorite session, I think, was the supply chain. That was really interesting and definitely very timely. So thanks very much to everyone, and we look forward to joining you in the networking lounge, and we look forward to joining us for our next RSM event. Have a great day.
Thank you.